Imagine you are 60 years old and close to retirement. It's time to relook at your investments and portfolio to figure out how to put your investment corpus accumulated through all these years of your life to its best use. How to get regular income from your investments? How to keep your money safe and simultaneously keep it growing so that it does not lose its value given the inflation. In today's video, we are going to touch upon all these points. Hello and welcome to our channel, Shine Path Investments, where we discuss investing and personal finance. In today's video, we are going to look at different investment options for senior citizens. We'll also discuss their present returns and the purpose they will serve in your portfolio. But before discussing the investment options, make sure you have all the ticks in the checklist on your screen. 1. Have your emergency fund ready. Invest 12 months equivalent expenses in highly liquid options like bank savings accounts or liquid funds. This money should be able to take care of any emergencies coming your way. 2. Get a big health insurance cover. At the age of 60, you would have cleared your debts and most probably won't have financial dependence. Therefore, you don't need life insurance. The only insurance you need now is medical cover. You are unlikely to get one after 60, and even if you do, it is likely to be super expensive. So, better to acquire a big medical cover before turning 60 or keep some money aside to meet medical emergencies. 3. Diversify your investments. Don't put all your eggs in one basket. Diversify your investments to balance risk and growth. At this stage, you want to avoid both high-risk options and places that can't even outpace inflation. The last thing you want is for your money to lose value over time. I hope you have got all the ticks. Now, let's take a look at the investment options suitable for senior citizens. Senior Citizen Savings Scheme, or SCSS, is a government-backed scheme that offers interest on deposits valid for those above 60 years of age. It gives the security of assured income for the entire tenure of the investment. You can invest a minimum of 1,000 rupees and a maximum of 30 lakh rupees in one go under SCSS, but the total investment amount cannot exceed 30 lakh rupees across all your accounts in this scheme. Currently, SCSS offers an interest rate of 8.2%. You get interest on a quarterly basis. After your first investment, unlike other fixed income options, you don't get the option of reinvesting the interest because this scheme is built to provide regular income to senior citizens. The interest rate is reviewed every quarter by the government, but the changed interest rate will not apply to already enrolled investors. New rates of interest only apply to new investors during that particular quarter. Post Office Monthly Income Scheme, or POMIS, is available not only to senior citizens but anyone above the age of 18 years can invest, with minors allowed to invest through their guardians. As the name implies, this investment option gives you fixed interest on a monthly basis. It currently offers an interest rate of 7.4% per annum, reviewed quarterly by the government. The minimum investment amount is 1,000 rupees, and you can invest a maximum of 9 lakh rupees in one go under a single name or 15 lakh rupees under a joint account. The investment tenure is 5 years. Senior Citizens Fixed Deposit Scheme, Bank Fixed Deposit, or FD, is one of the favorite investment options among Indians as it provides guaranteed, almost risk-free returns. Banks offer special, higher rates of interest to senior citizens. For instance, SBI is offering an interest rate of 7.30% on its one-year FD to senior citizens, whereas for non-senior citizens the interest rate is lower at 6.8%. Now broadly, there are 3 categories of mutual funds: equity funds, debt funds, and hybrid funds. Debt funds. As mentioned earlier, debt funds like liquid funds and overnight funds are useful to park your emergency funds. These funds invest in very short-term securities, like overnight funds that invest in papers maturing in 1 day, and liquid funds that invest in papers maturing in up to 91 days. These are safer and suitable for emergency fund parking. Equity funds. Equity funds invest in the stock market, and while riskier, they historically outperform other asset classes, especially when it comes to beating inflation. You would not require all your retirement corpus at once, so equities are useful for investing that portion of your accumulated corpus that you may not need for 10 years or longer. Historically, equity mutual funds have delivered returns of around 10 to 12% over longer periods, 10 years or more. Hybrid funds. These invest in a mix of both equity and debt. They offer a balanced risk-reward ratio and can be a good choice for senior citizens looking for a diversified option. For more details on which equity funds to select, you may watch other videos on our channel, which will give you detailed insights into different kinds of equity funds. I hope this video will help you create clear investment strategies as you turn 60. If you have any queries, feel free to drop them in the comments section. Thanks for watching, and I'll be back with another insightful video soon. Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.